Welcome back to the AlgoBot channel, where we break down automated trading strategies for MetaTrader 5 in plain, practical language. I'm AlgoBot, and in today's video we're exploring an expert advisor called Low Friction Trend Pullback. This is a trend continuation approach with an unusual gatekeeper. Instead of a classic momentum oscillator, it uses the Corwin-Schultz high-low spread estimator to measure market friction, and it only participates when conditions look calm and liquid. By the end, you'll understand how it reads the market, how it enters and exits, and the exact code behind it. Remember, this is educational content only. Let's dive in. So what exactly does this expert advisor do? At its core, Low Friction Trend Pullback is a trend continuation strategy for MetaTrader 5, designed primarily for the foreign exchange market. It aims to join an existing trend during a temporary pullback, rather than trying to predict tops and bottoms. What makes it distinctive is the single filter it uses to decide whether to participate at all. Most trend systems gate their entries with a momentum oscillator or a volatility band. This one takes a different route. It borrows a tool from academic market microstructure research, the Corwin-Schultz high-low effective spread estimator, published in the Journal of Finance in 2012. That estimator reconstructs the effective bid-ask spread, a proxy for trading friction, using nothing more than the high and low ranges of 2 consecutive candles. No volume data is needed, which makes it well suited to the decentralized foreign exchange market, where reliable volume is hard to come by. The economic idea is straightforward. Durable trends tend to unfold in calm, liquid conditions, where the cost of transacting is low. When that estimated spread spikes, the market is stressed or thin, and continuation attempts are more likely to whipsaw. So this strategy only looks for entries when the smooth spread sits in the lower part of its own recent range, a low-friction regime. Filtering out the noisy, high-friction periods is where the design aims to keep drawdown contained. Who is this style suited to? It's aimed at traders who are curious about market microstructure and who prefer a selective, patient approach that stands aside more often than it acts. As always, this is an educational breakdown of how the code behaves, not a promise of any particular outcome. Let's look under the hood. Let's walk through the machinery step by step. The heart of this expert advisor is a measure of market friction. On every completed bar, the strategy takes the last 2 candles and feeds their highs and lows into the Corwin-Schultz high-low spread estimator. This formula recovers an estimate of the effective bid-ask spread using only the high and low ranges of 2 consecutive bars, with no volume data required. In simple terms, it asks how much hidden cost, or friction, is baked into recent price action. The raw spread estimate is then smoothed with a short moving average, using the spread window parameter of 10 bars to reduce noise. Next, the strategy ranks that smooth value against its own recent history, looking back across the spread rank window of 60 values. It compares the current reading to the 50th percentile of that distribution. If the smooth spread sits at or below that percentile, the market is considered low friction, calm, and liquid, and the door to trading is open. If friction is elevated, the strategy simply stands aside. Alongside the friction gate, the strategy needs a trend. It maintains an exponential moving average with a period of 34, then measures the slope of that average over the last 12 bars. To make the slope comparable across different volatility conditions, it divides the change by the current average true range. If that normalized slope is above the slope threshold of half an ATR, the trend is up. If it is equally negative, the trend is down. Otherwise, the market is treated as directionless and no trade is considered. With a confirmed trend and a low-friction regime, the strategy waits for a specific entry condition, a fresh pullback reclaim of the moving average. For a long, the previous candle must close below the EMA, and the current candle must close back above it. Price dipped, then reclaimed. For a short, it is the mirror image, the previous close above the EMA and the current close below it. When all conditions align, the strategy opens a single position. The stop loss is placed 2 ATR away from entry, and the take profit is set at 1.8 times that risk distance, giving a reward-to-risk ratio of 1.8. Once the trade gains 1 ATR in its favor, the stop is moved to break even, and from there it trails behind price at 1.5 ATR, aiming to protect open gains and keep drawdown contained. Here's the core of the MetaQuotes Language 5 code as it appears in MetaEditor. At the top are the input parameters you can adjust in the strategy tester. EmaPeriod sets the trend average to 34. Slope loopback and slope threshold ATR define how the slope is measured and how steep it must be. Spread window, spread rank window, and spread percentile control the friction filter, how the spread is smooth, how far back its distribution is ranked, and the percentile that marks the low friction boundary. ATR period, ATR stop multiple, and reward risk govern the risk and target sizing, and lots is the fixed position size. Below the inputs is the decision block. First comes the friction gate. The code computes the smooth spread, compares it to the percentile threshold, and returns early if friction is not low. Then it defines the two pullback reclaim conditions. The long reclaim is true when the previous close was below the EMA and the current close is above it. The short reclaim is the opposite. Look at the buy branch. When the trend is up and a long reclaim is present, the code reads the ask price, sets the stop loss to ATR below entry, sets the take profit at reward risk times that distance above entry, and calls trade.buy. The sell branch mirrors this exactly. When the trend is down and a short reclaim appears, it reads the bid, places the stop above entry, the target below, and calls trade.sell. Both sides share the same ATR-based risk framework, and only the direction changes. Let's bring it all together on a chart. On the price panel, you can see the candles with the trend EMA drawn over them, and below is a subpanel showing the smooth Corwin-Schultz friction estimate, with a dashed line marking the low friction gate. Green below the line means calm, liquid conditions. Red above it means elevated friction, where the strategy stays out. Keep in mind that this gate is relative. The strategy compares the current friction reading to its own recent distribution, so it adapts to whatever is normal for this market. Watch the opening candles. Price is stepping higher, and the EMA is sloping gently upward. So the strategy's ATR normalized slope has cleared its half ATR threshold, and the trend is confirmed as up. In the subpanel, friction is sitting comfortably in the green zone, while below the gate, telling us the tape is calm. Now notice the pullback. A candle pushes down and closes below the EMA. This is the dip the strategy is waiting for in an uptrend. On its own, a dip means nothing. The strategy needs the reclaim. On the very next candle, price pushes back up and closes above the EMA again. That is the fresh pullback reclaim. Because the trend is up and friction is low in the green zone, all conditions align, and the buy entry marker appears. The strategy reads the ask, places its stop to ATR below, and sets the take profit at 1.8 times that risk. From there, follow the candles higher. Each bar builds on the last, and because the entry happened in a calm, low-friction regime, the advance is orderly rather than choppy. As price climbs, once it gains 1 ATR, the stop ratchets up to break even, and the ATR trail follows a step behind, at 1.5 ATR under price. Price reaches the take profit target marker, and the long trade is complete. Now the character of the market changes. Price rolls over, and the EMA flattens and begins to slope down. After a few declining candles, the ATR normalized slope crosses below the negative half ATR threshold, so the strategy now recognizes a downtrend. Keep an eye on the friction panel. It briefly ticks up into the red zone as the market turns, and while friction is elevated, the strategy holds off, exactly as its design intends. Then comes the counter-trend bounce. A candle rallies and closes back above the EMA, the pullback within a downtrend. On the next candle, price fails and closes back below the EMA. That is the short reclaim, the mirror image of the long setup. Critically, friction has settled back into the green zone below the gate, so the low friction condition is satisfied again. The sell entry marker appears. The strategy reads the bid, places its stop to ATR above entry, and sets the take profit 1.8 times the risk below. Now price works lower, candle by candle. Just as before, once the trade gains 1 ATR, the stop moves to break even and then trails at 1.5 ATR above price, following the move down. Price reaches the take profit target marker, and the short trade completes. Notice the common thread across both trades. The direction came from the EMA slope. The timing came from the pullback reclaim. But the permission to trade it all came from that friction gate in the green zone. That single filter, sitting out when the estimated spread is high and only acting when it is low, is the idea the whole strategy is built around. And that brings us to the end of our look at the Low Friction Trend Pullback Expert Advisor. Today we unpacked how it uses the Corwin-Schultz high-low spread estimator to gauge market friction, how it only participates in calm, low-friction regimes, how it confirms trend with an ATR-normalized EMA slope, and how it enters on pullback reclaims with ATR-based stops, break-even, and a trailing exit. Everything here is for educational purposes only and is not financial advice, a recommendation, or a solicitation to trade. Trading carries real risk, and losses do happen. If you found this breakdown helpful, please like the video, leave a comment with the strategy you'd like us to analyze next, and subscribe for more MT5 strategy walkthroughs. You can find more at www.algobot.live. Past performance does not guarantee future results. Trade responsibly.